Thank you, Mr. Chairman, and I appreciate you all being here. I know we have another panel coming up, and I would like to have an opportunity to talk with them as well. But to me, the problem here is not Caterpillar, it's a broken tax code. And I think this is not just an important matter, I think it's an urgent matter. In response to the question Mr. Johnson asked earlier, you indicated that some of your other clients are actually moving some of their operations overseas. It's happening as we sit here today. And it's a fiduciary responsibility if you're a publicly traded company, as was said earlier, to look where you can maximize your profits for the stakeholders. And I'm very concerned about it. In my home state of Ohio, we have companies that have left our state to be domiciled somewhere else because of the tax laws. One company merged with a company 1/4 its size in Ireland in order to take advantage of the lower rates in Ireland. And their headquarters is now not in Cleveland, Ohio, but we lost one of our Fortune 500 companies to Ireland. I'm a beer drinker. If you want to try an American beer, good luck. Luckily, I like Sam Adams and Yuengling. They're the biggest now. They have 1% market share each. Every other beer company is now foreign-owned. And when I ask people why, including the folks who purchased these companies, they tell me it's the tax code. And this is a big deal. It's not just the loss of jobs, although that happens. It's also the loss of corporate headquarters, which has an intangible impact on all of our communities, including a lot of the good work that our companies do here for the nonprofits and to help to make a better way of life for everybody in those communities. So this is not just an important matter, it's an urgent matter. For that, I thank the chairman for holding this hearing, because I hope it will shine light on the fact that we have a broken code, not just the highest rate among all the developed countries now, which is not a number one you want to have now that Japan has lowered their rate. We're number one. But the fact that we have an international tax code system that is so non-competitive and so complicated that it is driving jobs, investment, capital overseas. Of our OECD partners, the other developed countries, almost all of them have gone, as you know, to a territorial system. If you could talk about that for a second, I would appreciate it. Mr. Quinn, you may be the right person, but you all decide. What impact is this having on your clients as they look at what their options are going forward because of the U.S. tax law being so antiquated, inefficient, and non-competitive? What impact does it have on them? And specifically, you could address not just the rate being so high, but the fact that we have a worldwide tax system that makes it difficult for them to be able to do business overseas and easier for them to move those businesses overseas.
Yes, that it is the issue that's at the forefront of many decisions and many conversations that are taking place within corporate tax departments throughout the population of U.S.-based multinational companies. That this debate around how the U.S. has decided to tax foreign earnings is one that's of critical importance as U.S. companies continue to grow and expand offshore. That cost becomes an increasingly larger portion of their overall cost structure for their business and their ability to compete with foreign companies. We have, as you said, we are one of the few, if not the last remaining country which still taxes worldwide earnings. It doesn't employ a territorial system, and that is a considerable competitive disadvantage when companies are trying to compete against companies that don't have the same tax burden, even in the U.S., that a U.S.-based MNC might have. Senator, a lot of the debate that I hear, the discussions that take place among my clients, a lot of it has to do with rate as well. It's not just the basis of taxation, but the rate that applies. And I think there was some questioning earlier about, well, what's the right rate that would incent this type of activity or cause this activity to go away? And a lot of that, I think, is if the U.S. corporations were established and could be subject to a rate of tax of 20% or less, there'd probably be very little incentive to continue moving business activities outside of the United States. If you think about the opportunity now and express it in percentage terms, the opportunity to move from a 35% tax rate to a 10% tax rate is a 25 percentage point improvement. That's material. When you start talking about a 20% tax rate moving to a 10% tax rate, that's only 10 percentage points. And it becomes much more, when you look at the costs and the relative benefits, much more of a push. And so I think the companies might be looking at both sides of that question, both the basis of taxation in terms of its territorial, the need for a territorial system, as well as the tax rate that would apply. Their feeling is that you might actually, at a lower tax rate, bring more income into the U.S. tax net
Yeah, I think that's very likely. In fact, you would see a lot of repatriation, wouldn't you, of the over $2 trillion that is now tied up overseas. People aren't going to bring it back at the high rate, so the two are combined. Let me just make the obvious point, which is we've done this before. You know, in the 1980s, we looked at our tax code and said, let's end up with a rate that is below the average to be competitive. And this was in the 1986 Tax Reform Act, and we took the rate, as you recall, down to 34%, thinking that that was getting us below the average. To get to below the average now, we'd have to be, when you include our state corporate rate, as you indicate, somewhere in the low 20s probably. 25 is the rate that some of us talk about. But you need to get at least to that, which is probably right in the middle. Since 1980s, isn't it true that every other one of our competitors around the world, all the other countries, have reformed their code? Every one of them has, except us. We're the ones left on the sidelines. And those reforms have included, as you indicate, going to a system of taxation that's more territorial, but also lowering their rates. And that combination of allowing people to pay their income taxes where their earnings occur and a lower rate has made us non-competitive. So I think the United States, frankly, has waited way too long to make these reforms. Well, every other country in the world that we compete with has moved ahead and gotten a more competitive tax system, and that's why it's urgent that we act now. And by the way, on the international side, it's been since the 1960s. So since the 1960s, we have not changed, whereas all of our other OECD countries, all the developed countries have adjusted. So I hope that you can be in a position in the next few years to be able to tell your clients, you know what, there's a new tax code that actually encourages you to stay in America and create your jobs here. And that's why we at PwC think you ought to stay here in America and take advantage of a better environment for success. Thank you, Mr. Chairman. Mr. Chairman, thanks very much. And I just had a couple of questions follow up on how the international code works and specifically as it relates to Caterpillar. You talked earlier about the fact that U.S. companies are competing globally at a disadvantage given the fact that we have a relatively high rate and because we are taxing on a worldwide basis rather than what they call a territorial basis, meaning if you have active income earned abroad, it's taxed at U.S. rates. What does that do to a company, Caterpillar is an example, but any U.S. company that wants to take advantage of the international marketplace and that wants to be competitive in terms of acquisitions as they come up? 80% of the purchasing power in this world is outside the United States. 95% of the consumers are outside the United States. We want our companies to access those consumers, that purchasing power, in order to create more jobs here, right?
That's correct.
And with regard to Caterpillar in particular, do you have any idea how many of their 51,877 U.S.-based employees are dependent on some extent on their international sales? I understand their revenue is about 67% overseas. So how many of the people who work here, over 50,000 people, have their jobs because Caterpillar does business overseas?
I don't know the exact number, Senator, but I would expect it's a large portion of those support the export nature of the business.
As of 2000, you had some testimony that some of your colleagues gave 14 years ago saying that you estimated that exports supported 16,000 U.S. Caterpillar jobs here and another 30,000 U.S. supplier jobs here.
I wouldn't find that unreasonable.
So that number is going to be a lot bigger than that now that they have more employees and they do even more internationally, correct?
Correct.
So we're talking about U.S. jobs here being supported by giving U.S. companies access to foreign markets. And that's something we want to encourage, not discourage, because that creates more jobs here in America. Again, if there's an acquisition that comes up, let's say there's a company that becomes available and the competitors, let's say, are a German company, a French company, a Brazilian company, a Chinese company, or Korean company, and Caterpillar is in the mix. What's the relative advantage or disadvantage based on the tax laws for those acquisitions?
So, what they'll be looking at whenever an acquisition is made is what's the earnings opportunity in the future, and that earnings opportunity is going to be viewed on an after-tax basis. Mm-hmm. So they'll take a look at the tax costs that will be associated with the earnings in that business as well. I'm sure the example you gave earlier of the company within your state took a very similar approach to it, just hard economics of looking at what is that after-tax cost of operating as a U.S.-based MNC or a foreign-based multinational company.
And what I'm hearing from the companies in Ohio, and I'm sure the same is true in Michigan and Wisconsin, is that they are not just at a competitive disadvantage globally, but in terms of these acquisitions, other countries' companies can pay a premium because of those after-tax profits that they're looking at.
That's
in other
correct.
words,
Yes.
we're having to not just compete head-to-head, but we're shrinking as American companies relative to what we should be because of our tax code, because other companies can come in who are domiciled somewhere else and say, hey, I'll pay you a premium, so that we're not expanding as we should be and therefore not taking advantage of these international opportunities that creates jobs here in America. Who are CAT's biggest foreign competitors, do you know?
Certainly Komatsu, which is a Japanese-based company. Steve, would you have any others to add?
Volvo, which is a Swedish company. Now some Chinese companies are competitors.
Yep.
And from Korea as well.
Korea, Samsung, and others.
Volvo is their top competitor in Europe, I'm told, and by far. Komatsu probably in Asia, and the Chinese companies are growing their market share. Volvo's in Sweden, where the top rate is 22%, so it's 17 points lower than the combined U.S. corporate rate of 39.1, which would be the state and federal. Based on the public financial statements for both companies, CAT's effective rate was 28.5% last year. Do you know what Volvo's effective tax rate was last year?
Certainly lower than that, I would think.
You have a guess?
Low 20s.
20%. So 28.5% for CAT. Volvo, their biggest competitor, 20%. So it sounds to me like, you know, Caterpillar spent lots of money coming up with a tax strategy last year that didn't even allow it to come close to achieving tax parity with its primary rival in Europe. Is that accurate?
That's a characterization.
You shouldn't feel guilty about it, but I mean, that's
Yes, it's accurate, Senator.
that's the reality. I would also say that there's a big issue here as to the ability to deploy resources to its most efficient uses. So it's not just the fact that the Volvos of the world have a lower rate, it's the fact that because they work on a territorial basis rather than a global basis, they can move capital around to where they need it, which is a huge advantage, and Komatsu has the same thing.
Yes.
So, you know, the Japanese have a 95% exemption rate, as you know, meaning that they allow their companies to do business in the United States, but then bring those profits back and be able to deploy them in Japan or elsewhere without any tax penalty. And so, look, I know this is about CAT today, and I know that the chairman's raising some specific points about our current code, but this all just cries out for reform. And if we don't, we're going to continue to see an erosion of U.S. jobs, U.S. capital going overseas, the lack of investment here in this country, and the inability for U.S. companies to expand as they should be able to, for the reasons we stated earlier, that they're not as competitive on these acquisitions. So I really appreciate you all being here today, and I hope that, again, in the next few years, you'll be in a position to tell your clients that the U.S. now has a competitive tax structure, and you ought to stay right here and build your jobs and build your investments in the United States of America. Thank you, Mr. Chairman.